Skipping through to debt service coverage ratio. So this particular product, it's actually been around for a long time, but this has taken a bite out of the apple for the Fannie Mae second home product. Now, who's a good candidate for this product? This would be investors that have a tough time qualifying for a loan due to a maxed out debt to income ratio. The individual might have more than 10 financed properties, or there just might be a candidate that just doesn't want to deal with the whole providing tax returns, P&Ls, and everything that goes through that particular process. Let's talk a little bit about that DSCR. So what is DSCR? Who understands or has no clue what DSCR loans are and how they work? Perfect. Debt service coverage ratio, the main component, if I had to break it down in Fisher-Price terms, a DSCR loan, what we're looking for in a DSCR loan is we want to see equal or greater rent potential on the subject property as compared to the principal, interest, taxes, insurance, and any association dues if applicable. Now, that is the main component. We do not look at your personal income to qualify. We are not looking at your tax returns, your W-2s, your bank statements. That doesn't matter. The DSCR loan is a business purpose loan for a non-owner occupied property. Now, as far as credit on it, we will go down as low as a 620 on it, but at that point, the interest rate is going to be very unattractive, and you're going to have some loan to value or down payment restrictions that might make it prohibitive. Now, what are some of the advantages about the DSCR? Again, it's a no doc qualifier, meaning we're not collecting any of your income statements. All we really care about, again, is will this subject property debt service the mortgage? And where is the money coming from? That's the other thing. We want to understand where the money's coming from. Anyone lending in this market today is going to be subject to the Patriot Act, and inside that Patriot Act there's going to be the anti-money laundering laws. So we must source where that money for the down payment's coming from. Beyond that, not a whole lot. We want to see that the credit's good. We're looking, and we don't want to see derogatory credit events within the last 12 or 24 months. And if there are, we will still lend on it, but we do have a cap on some of those derogatory events. Disadvantages. Typically on a DSCR loan, you're looking at higher lender fees. And we'll get to that a little bit more later. Because the DSCR product, 95, maybe even 99% of the DSCR product in this country is originated through broker wholesale channels. And we'll get into that a little bit later. So the time to close is about 10 days longer than what you're going to see with a conventional loan or any other type of product that you might use for an STR purchase. Less lenders offering this product, so that becomes an issue. The mortgage IQ amongst the lenders that are now originating these DSCR products is not great. That's the truth. These DSCR loan products are considered, they're classified as non-QM, non-qualified mortgages. What is a qualified mortgage? A qualified mortgage is going to be your conventional FHA, VA, stuff like that. Now, what we've seen in the last 24 months was the largest boom in the mortgage industry from a production perspective. We saw pretty much anyone that had a mortgage refinance, probably every one of you in this room that either had a mortgage on your primary residence or even your investment property, refinanced within the last 24 months. Some of you did it probably in the twos, high twos, so many of you in the threes. And through that, every lender in this country was busier than they had ever been. And then what happens at the beginning of this year? We have inflation. The Fed needs to stop pulling on that lever. All of a sudden, interest rates go up. Refinances are gone. So all this production, all these lenders, all these originators are like, okay, how am I going to make a living? And you go out there and they're trying to originate purchase loans for inventory, but inventory is low, right? And so they're having to figure out how they're going to replace this lost production. So you've seen this huge mass influx of new lenders out there trying to offer non-QM loans. And just in the Facebook groups that we all participate in, if we just move the clock back to fall of last year, anytime there was a conversation about investment property financing, you might see 2 or 3 people pop their head up in the comments and offer their service. If you went in there right now today and you asked that question, you're going to see 13, 14 people. That's because they're having to figure out where are they going to replace this production, how are they going to make a living. So everyone's sprinting into this non-QM space right now. So the mortgage IQ amongst that is going to be a challenge. There's always going to be your seasoned people that know the basic fundamentals of originating and meeting the needs, but there's going to be a lot of people out there that are just going to stumble their way through that process. A disadvantage, I would say, of the DSCR loan as compared to the Fannie Mae product or others is there is a prepayment penalty. Typically with the DSCR loan, you're going to see a boilerplate 5-year prepayment penalty of about 5% of the loan balance, right? So if you were to sell, refinance, or even make additional principal reduction payments within those first 5 years, 5% of that would be subject to penalty. Now, what I want you all to understand is with the prepayment penalty, you can take the 5-year boilerplate or you can take it all the way down to a 0, all right, and everything in between. You can do a 4-year, you can do a 3-year, you can do a 2-year, a 1-year, or none. What that difference is going to translate to is cost, okay? The 5-year is where you have no cost, and that's where you're going to probably end up with the best interest rate. Or let's say you want a 2-year, you can end up paying some money to buy down that term on the prepayment penalty, or you can accept a higher interest rate which will yield rebate that you can use to pay for that, and we'll get into rebate and that in a little bit. Another disadvantage of these DSCR loans, these are not the government-sponsored enterprise-type loans. This is private money. These loans are being originated and sold on the secondary market in bundles. When things go sideways, these loans retreat very quickly. So that is a disadvantage. You might be in escrow, for example, in February of 2020. All right, we all know what happens around late February, early March of 2020. And all of a sudden, COVID hits, and then you see that private money retreat overnight. So you're in escrow all of a sudden, and then those products are no longer available. Right now in today's market, you know, we're talking about the economy and such. I don't think that's something that we need to be concerned about. But if you do follow the news, and if things do start going down that spiral, and you have a DSCR loan, you might want to consider having a backup plan on a Fannie Mae product. Again, I don't think that's going to happen. In fact, I personally believe that the economics that we're all being fed aren't nearly as bad. We saw a jobs report come out last week that was more positive than expected. And I think we're going to start to see some tailwinds in the economy that actually tell us a better story than what we're hearing today.